The stock market is tanking again. We have seen the stock market wiping out all of the gains from 2018 at this point after so much positivity about growth and employment. My hypothesis remains the same as it has always been. If central banks stop printing money and increase interest rates, stocks will fall. If central banks print more money and decrease interest rates, stocks may rise. In 2018, central banks have pulled back $1 trillion of their QE, and clearly that has been very damaging to this fragile market. You came here for the truth, so let me unveil that for you. Today we are going to look at what I had continued on from yesterday. This is an ongoing nosedive in the markets. I'm going to show you the details. I have a lot to cover and not enough time, so let's begin by taking a look at the markets themselves. At the time of this recording, in the middle of the day, the Dow Jones is sitting at negative 432. This has brought below the 25,000 mark yesterday. We continue to sink here. The Nasdaq is down, the S&P is down, depending on when you're watching this. Who knows where it ends up at the end of the day. However, we can see that it is in the red. I'll cover the issues and why and what's happening, of course. Kramer, you'll wish you sold at these prices if the Fed hikes rates in December. So he had suggested that investors sell their stocks now if they expect the Fed to hike interest rates next month. It is largely projected that the Federal Reserve will increase interest rates in December. Powell said it's coming in December. Look for it to happen and look for more. He is not necessarily worried about what equities are priced at. He's going by other metrics. Of course, the FOMC is doing that, and they are constantly making sure that they meet whatever criteria they have set. But equity prices are not necessarily what they're looking at. They have other factors. Now, there's a whole deeper layer to this that I will not cover in this video, which I have many times before. Dow drops 500 points, erases 2018 gains as Target and tech shares slide. So earlier in the day, the market was down actually over 500 points, and I found this article. I just wanted to show you that to give you an idea of how low it really went in this trading session here. U.S. recession chances edge up, and there's a risk of the Federal Reserve and their increasing of interest rates. They are expected to do so in December, expected to hike 3 times next year, but we'll see what happens. Now, they had polled these economists several times throughout the year, and it was largely expected December was going to happen for sure. It's going to happen. And now through October into November, they're starting to back away from that and starting to beg and plead for this not to continue. We'll see what happens. Of course, I will do a video about it as soon as that meeting takes place. The Dow may drop another 2,000 points before the stock market selling is done. That's according to the CNBC CFO survey. So they surveyed all of these different CFOs, and they are suggesting that it will have to drop significantly, in fact, below the 23,000 mark before it ever reaches above 27,000 again. Now, whether it's going to be in this cycle or the next, we'll have to see. If they continue to increase interest rates, it's just going to put further pressure downward, and I hope they really do, because the market needs to be restored back to reality. If you've been pushing it up with this artificial system, artificial money, quantitative easing, wouldn't you as an investor want that to be replaced by real money? If you have your own money in there, don't you want real money behind it, or do you want fake QE money? I would feel much more secure if I knew that real people had invested into these markets. But of course, people in their short-sightedness are simply worried about the numbers. They're saying, Fed, please don't stop printing money. Please, People's Bank of China, don't stop printing money. Get out there and push these markets up. Why are you doing this? What are you waiting for? All right. And they also talk about the fact that this would represent an 8% decline in the Dow from its current level. I have to suggest that we're going to be heading towards that 20%, that bear market level, if it gets down there. Now, this here is actually outdated because it's from the previous trading session, from Monday's trading session, but I needed to show you it because it really shows you how far this has come down. Market capitalization losses since their 52-week highs. Facebook, 250 billion. Amazon, 255 billion, Apple 222, Netflix 63, and Alphabet 155 billion dollars. And imagine that since their 52-week high, they have all come down such a significant amount. We're talking about $1 trillion now. FAANG stocks fall from their 52-week highs. The percentage change from the 52-week high to the low on Monday for each of the 5 FAANG stocks. Imagine all of these have fallen a few percent beyond what they were at the end of Monday's trading session. So these numbers are actually worse. Facebook, 40%, Amazon 25%, Apple 20%, Netflix 36%, and Alphabet 20%. So imagine a few percent on top of that. It is not looking good for any of these. Yes, they can absolutely come back to where they were before and beat their records. That is absolutely possible, but it has to be done in a way where the central banks are supporting it. If the central banks aren't supporting it, I don't understand how they're going to go up much higher. The buybacks can definitely be the number one reason why they see some positive encouragement, but are they able to push these up 20%, 30%, 40%? That's going to be very, very difficult. Tech's popular FAANG stocks have lost more than $1 trillion and counting from the highs amid the tech rout. We're talking about 1 trillion. Just imagine that number over just a few stocks in a short period of time. Imagine that. 5 stocks, $1 trillion wiped out in a market that we're being told is so safe and secure. $1 trillion in the grand scheme of all global equities, okay, it's not that much. But when you think about the actual market rout that has been going on, it's not just these 5 stocks. But when you see how much has been wiped off of their market cap, it is significant. This could be the final nail in the coffin for the FAANG trade. 3 of the companies within the big tech quartet have entered into the death crosses, with Facebook, Netflix, and Google's parent Alphabet seeing their 50-day moving averages cross below their 200-day moving averages. Facebook first, now Netflix and Alphabet, and Amazon isn't far off. And maybe today this is actually the case. We'll see where it ends up. You could see the death crosses right here, Facebook, Netflix, and Alphabet in that order, and it's not looking good for any of these stocks, all the FAANG stocks, the tech stocks, and actually everything is going to be victim of contagion. We can see the portfolios that are being readjusted right now, going into more of those, quote, safer stocks and leaving some of the growth behind. That's what we're seeing at this time here. Goldman says it's time for equity investors to boost their cash. It's a little late for that, I would think, if you're listening to this as advice, but I would just suggest that individuals should have been diversified in the first place. They should have been having their portfolio be balanced more, not all in paper. That's just not smart, but that's what they tell you to do, and this is the only advice they're willing to give. Stock investors have had a great run in recent years, but with cash now offering positive inflation-adjusted returns, it may be wise to dial back on risk. Mixed asset investors should maintain equity exposure but lift cash allocations. Cash will represent a competitive asset class to stocks for the first time in many years. Things are certainly changing right now. You can see the appeal of cash. This chart right here, money market yield spread over the S&P 500 continues to grow. And that wasn't the case all of these years, just up until recently now. That has been what has occurred throughout 2018. It has become more apparent, and we haven't seen this, guess what, since the financial crisis. Yet another indicator. This is out of the Financial Times. Just wanted to show you one of the stocks that is leading the charge on the way down. Target shares dropped 12% as the retailer's investments hit margins. This is one of those stocks that desperately needs to have a very, very good holiday sales season. They need to sell a lot for Black Friday. They need to sell a lot during Christmas and Boxing Day. And if they don't, they're going to be in big trouble. We're going to see more layoffs. We're going to see more store closures. It's not just retail, of course. This goes for all different types of businesses. They have to do very, very well. Look at crude oil right now. WTI has fallen to about $55 a barrel. Brent crude is below $65 a barrel. This has been really, really pulling down on all of these energy companies. I think it's a good thing when energy is priced low for the economy. However, if it gets too low, then you start to have a problem with all the jobs in those areas. We have a lot of the fracking, a lot of the shale that has been coming onto the market. What do you think is going to happen to all of those regions where there's reliant on oil? That's not good for them. That's not good for the real estate. That's not good for the businesses that surround that. And ultimately, you have higher unemployment as a result. This has happened multiple times before. It is a high risk, a high volatile market when you get into those areas surrounding oil. All right, recession is so far in the distance, I can't see it. So that's according to Larry Kudlow. And of course, this is what they tell you at the worst time. In fact, this is usually the case when you have something to worry about. Whenever they come out and try to tell you everything is fine, that's a pretty good indicator that everything is not fine. It's not 100% of the time, but certainly this is truly worrisome to me. When you wipe off $1 trillion in market cap, we have to start adding it all up, looking at the other markets, looking at the other stocks, looking at how the alternatives are looking for our portfolios, and make adjustments accordingly. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. So if you just click that one button, you're supporting me. If you leave a comment, you're supporting me. All right, and I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, well then, these two books have it all. You can actually flip through them for yourself in the link in the description. I get into everything, talking about the foundation and the history. Then I talk about the asset classes, how to make money. I talk about tax incentives, self-sufficiency, and so much more. So check them out in the description at the link over there, or you can go to themoneygps.com and I have the trailers for these books and I flip through them quickly just to give you an idea of what they're all about. That's at themoneygps.com along with the audiobook version. So check that out. Take care.